Hello, everybody, and welcome to My Two Sats. My name is CJK, and today I'm joined by Mike McGlone, Senior Commodity Strategist of Bloomberg Intelligence.
That's just pretty extreme. It shows you how the system potentially is breaking for the rest of the world. I mean, why is Japan having to support their currency? Why is China having to support their currency? It's because their yields are so high in the US, rates are so high, and the rest of the world, by terms of bond yields, are tilting towards recession. People say, oh, their deficit, and rates are going to go up, and long bonds are going to go to 7%. Those type of things are completely global recessionary trajectories because the whole world's tilting downward, and there's only one little inflection that's going to make it accelerate, and that's the US stock market. And one of the best leading indicators for this, CJ, might be Bitcoin, because I want to harken back what you just said for earlier. It's 24/7 traded, 365. It's the number one leading indicator on the planet, bar none, on a 24/7 basis. One thing I love about it too is it's so unifying. Everybody in the planet can be unified via Bitcoin. It's so cool. You can meet people at conferences from all over the world, and they're trading Bitcoins oftentimes with dollars.
Hello, everybody, and welcome to My Two Sats. My name is CJK, and today I'm joined by Mike McGlone, Senior Commodity Strategist of Bloomberg Intelligence. Mike, thank you so much for joining me, and welcome.
Well, hello, CJ. Thank you for having me.
It's an absolute pleasure. And for my listeners out there, I first met Mike at the Bitcoin Energy Summit, a great conference. And then I later had the pleasure to moderate a panel that he sat on at Bitcoin Day Miami. And that's when I knew Mike had some very sophisticated, almost hybrid TradFi, DeFi views on Bitcoin and the future of finance. So I'm really looking forward to diving into our topics today, which include Bitcoin as a commodity, security, technology, Bitcoin's long-term role in the TradFi ecosystem, of course, the U.S. interest rate outlook, and importantly, U.S. dollar dominance and global macro. But before we dive right into our topics, Mike, I always like to kick off the show with allowing our guests to kind of tell their Bitcoin orange pill moment. So that moment where Bitcoin kind of just clicked for you.
I appreciate how you started out with this. I just love the migration of language and learning nomenclature and stuff like that, vernacular. And like the word TradFi, I mean, I started in the trading pits in Chicago, the futures trading pits, those Roch's trading pits in the 80s. And we thought we were ahead of the game. We were driving I was in treasuries, and we were driving the treasury market, took it away, all that business away from New York. And yeah, that was great and cool. That's what I just see happening in cryptos. And the thing that really hit me was two things. So I learned about Bitcoin from my son, my eldest son, who's now 30. And I think it was 2011. And he was a freshman in college, and he started mining some Bitcoin on his laptop. He lost it. And, for me then, was it 11, 12 or so? It was silly internet money. And then I came around, and there was one key thing that pivoted me was going to Hong Kong in 2018. And it was a pretty significant bear market. And I always kind of believed in the technology, but I started writing about it in Bloomberg in 2017. And I said, this is just silly. It's going down. And I'm sorry, but it's just the way silly markets are. The technology is great, but right now, as a strategist, the price is too high. And then what really hit me in Hong Kong in 2018, I remember pointing out in presentations and everything that everything's going down, it's plunging, but one thing was going up. And that was the market cap of Tether. US dollar. It's $2 billion then. Now it's $111 billion. And I remember talking to all my colleagues. This is right before the riots, and right after, it was a pretty significant typhoon that came in. I remember I arrived the day after. There was guys with chainsaws everywhere. But all my colleagues who would talk about the mainland this and mainland that said, Mike, no, get this. I can't pick up my phone because I'm using my phone for this. Is for the first time in history, we and people in China and the rest of the world are getting access outside of our systems to an alternative currency. It didn't really mean Bitcoin. It meant the dollar. And they're able to get away from their melting currency. So definitely Bitcoin, it really solidifies my view that Bitcoin is simply digital gold in the space, and that the dollar is unstoppable because this organic, new, rapidly advancing technology adopted it as its base case. And so the final epiphany for me was in 2019. Remember when New York Attorney General came down really hard on Tether? Tether broke the buck. Bitcoin dropped below 5,000. And then for the week, it all bounced. Right that day, I got bullish. With that week, I'm like, all right, it's going up. It went from like 17,000 down to 3. And then, okay, I didn't get bullish right away, but at 5,000, this is going up. And, I've been imperfect, but overall, it's just that still is underlying the technologies, what it's doing to the world and what's doing technology. And what's really happened in this country lately is great. Stuff I kind of just fully expected. That is, when something has a rapidly advancing technology has money, okay, it adopts the dollar as a base layer. It gets votes. It's got passion, and the widest held entities in this space hold U.S. Treasuries. U.S. legislators and regulators aren't going to mess that up. And there's always going to be a few idiots, but let them be idiots. That they go down in history as the idiots.
Right.
So that's where we are now.
That is I love that story, coming from all the way from the pits of the floors all the way up, seeing it, just being a veteran and a great strategist. And I sat on that panel with Byron Donalds down at Bitcoin Energy Summit. And one of the interesting things he said was that on the Financial Services Committee, our politicians are talking about the concern of a potential lack of demand on U.S. Treasuries. And then you turn around, you look at the Bitcoin ecosystem, the crypto ecosystem, and you see U.S. dollars, these stable coins, upwards of $150 billion market cap now when you take Tether and USDC.
Yeah.
And you say, wow, talk about adding an extra source of demand for the dollar. Bitcoin is good for the U.S. And I heard you mention there, actually, and I know this isn't part of our topics, but I want to pick it out of you, the role it plays in the vote. These last couple of days, what do you take away from what we've seen happen politically with Bitcoin and stablecoins?
The flip in Ether was shocking. I mean, here's my base take. In the big picture is, it's just a matter of time that there'll be a widely tracked ETF that tracks a broad basket of cryptos like the S&P 500, like they do for equities and bonds. And so we've got the first one. Had to get over the first hump of Bitcoin. And we just went through the classic, I think, historic nuances and discourse of how great our system is. People forget, okay, there's a lot of disagreement, but we argue, we work it out, we bang it out, and then we come to a proper conclusion, as Churchill said something like that. You don't do that in China and Russia. You listen to one person. So we did that. It's just a matter of time. We work it out. Ethereum, the approval of the Ethereum ETFs was to me, it was a matter of time. And I knew it was just a matter of time that the ETH discount was going to go to zero, but I can't trade them, which is good because that's why I have a better view. And it's like 1. And so we've done that. So what's the next step? It's just a matter of time. These are all the steps of coming to the right conclusion after exhausting all available options. So to me, that's where it is. But that's why I'm really impressed now. We're in the election season, and it's completely politically correct. If you want to get votes in this country, bash China. Okay, bash Iran. Trump taught us that. So as much as people might hate him, he taught us that. It works well. And now people are starting to figure out, okay, if I want votes, I probably shouldn't push back on crypto too much. And I think the Democrats twist a little bit too far to one side, and they're kind of coming back in the middle. I'm like, okay, we're going to lose votes if we're stupid about this. Elizabeth Warren, thank you very much, but you might be a few terms away from history. We want to go forward here, and we want to get elected. And so there we go. To me, it's just a matter of time that things. So when we launched the Bloomberg Galaxy Crypto Index in 2018, it was firstly my idea. 2017. That's not too simple. I did it with my colleague James Seifert. It's just completely logical. I mean, I came from an indexing environment. I worked at S&P indices, running commodity indices. It's just, to me, it's just logical. When you have people like the SEC who say you want to protect investors, okay, well, they should allow investors to track an index that tracks an ETF that tracks an index of cryptos rather than taking shots at making them just speculate.
Right. Yeah, the ETH ETF was, I think a lot of people were like, whoa, what just happened? And it kind of brings us to our first topic, which is, is Bitcoin a commodity? Is it a technology? Is it a security? How do you feel about that? And how do you think the broader marketplace is kind of viewing it? And how is that view evolving as time goes on?
So what really hit me is Bitcoin's everything. The bottom line I start with is the digital gold narrative played well. I think that was one of the first books I read by Nathaniel Popper. Gosh, was it 2017, 16? Whenever it came out, I read it. It was within a year. That's, to me, makes sense. And the way I started out as a commodity strategist, okay, this is very simple. If you hold analog gold and you don't have some digital gold in that space, you're at risk of the world just moving rapidly, advancing technology, moving ahead. Like I came from the trading pits. I was in Chicago a week ago, and poof, trading pits are gone. I mean, there used to be 100,000 people working around those pits. Gone. What is that? It's rapid advancing technology. And so to me, that's what I look at. The bottom line is, okay, that's the space. If you like gold, if you're holding gold, if you've always invested in gold, you probably should have some Bitcoin in space, a couple percent, just in case that your analogs are replaced by digital. Then there's the simple facts of definable diminishing supply, which is I love. I mean, I remember doing that metric like 5 years ago. Like, wow, I mean, I can predict out 10 years, know exactly what the supply is. That's a shocker. And increasing demand and adoption. So to me, over time, price must go up, just unless something shifts. So to me, that's the bottom line. It's a commodity. It's a technology. It's everything. One thing I did enjoy writing about, as far as being peer-to-peer capital, isn't that in the Satoshi Nakamoto's white paper, peer-to-peer cash?
Payments. Yeah, peer-to-peer
payments, right.
payment. Yeah.
I never agreed with that. And I remember writing an article about that, pointing out this Satoshi Nakamoto's mistake. And I did it intentionally, not to piss off Bitcoin people, just point out facts of what's happening in this space. Is to transact value amongst people, having a currency that depreciates slightly over time is perfect. Depreciates a lot, forget it. But something that appreciates over time, why would I ever use that to buy anything? You've got to hold that. That's what Bitcoin is. So he created something that's going to appreciate over time. The number go up technology. I mean, whether I love it or not, I hate it. I don't care. As a strategist, it works. The price should go up over time. But that's when we tilt over to other things where there's certain times it's going to get too expensive and certain times it's going to get too cheap. But to me, that's the bottom line. And just to point out some facts of, there's going to be some things we're going to talk about that I will say I'm not as fluent as I used to be, because Bloomberg has asked me to curtail coverage of Bitcoin. There's been senior management who's just not as favorable to cryptocurrencies, as they call them. I call them speculative digital assets is what I say, really call them what they are. And then there's Bitcoin and a few other ones. So I have. And so I focus more on the macro indicators of what Bitcoin means when it does this and that. And I haven't written about Ethereum in a year. But since they've asked me to curtail coverage, we've had the biggest ETF launch in history, tracking Bitcoin. I'm like, okay, I just want to see how this works out. I'm very happy working for Bloomberg. I have to work with what senior management wants, and so far, that's what we're doing. So some of the weeds I don't follow as much anymore.
That's interesting concept that they would curtail coverage, because you do a great job, actually. And I think I'm going to pull up one of your tweets here in a second, where you talk about gold and its relativity to treasury bonds and the stock market and how it reacts to global liquidity levels. And Bitcoin kind of does like the same thing. Maybe actually I would say it does the opposite. Maybe it doesn't really react the way we actually want to see it when you think about the way the stock market moves and Bitcoin moves together versus divergent. And you would think that they would want to include that extra viewpoint, because it is a 24/7, 365 market that can be used as a great indicator. And you mention it in your tweets here, which, let me see. Let's start with it. Well, we're on gold as digital commodity. And you know what? Before I pull up that tweet, I have to tap on this subject, because you're a commodities strategist. This is your cup of tea. Yeah. Would you agree with the statement that over time, the price of any commodity gravitates towards its cost of production?
Of course. I wrote about that a little while ago. It's just the basics of Adam Smith's Wealth of Nations. In fact, recently I've been rehashing that. I read a lot during the weekend. Weekends I listen. I love listening. So I've been rehashing that audiobook, and I reread a few of the commodities sections. It really reminded me of what he was pointing out in 1776 about the cycles of commodities. It always migrates to the cost of production. It depends on how you define that. So I rewrote about the cost of production for corn is below $4 a bushel. It's a matter of time we go back there. Now we have to start with the most elastic commodities that respond to price right away. Corn is number one. Grains are number one. You can bring it on in a year, the supply, and actually sometimes less than a year if you include both South and North America, or the rest of the world, the Southern and Northern hemisphere. So that to me is part of the bear market I point out in commodities. Is it's got way above its cost of production. It really kicked in the the enthusiasm for production where I'm from in the Corn Belt, and that's happened, a lot of it in South America, and it's pressuring that price. So here's a fact about that. The leading example for all those type of estimates about the cost of production is corn will be one of the leaders this year, and it'll probably drop down below $4 to $3.75. And that's on one key premise, that we don't have a bad weather year. If we have a normal weather year, this is going to do the cost of production. So what's next in line? Typically, it's crude oil. Crude oil is one of the it's the most significant commodity on the planet. It's also the most autocorrelated. And I really love pointing this out. When it was running up to 130 in 2022, I was way too early. It's just getting above 100. On the way up, I said, this is going to be the high price cure to get it back below 50. I've been early. If I was a trader, I've been stopped out. I've been wrong. I've been fired. But it's still going to 50, maybe below that. Natural gas did it. U.S. natural gas went to 10, then below 2, went to the first price it started in trade in 1990. It's just a high volatility market. It's what happens in commodities in the long term. They always do that. Why? Number one reason is the technology you're seeing from cryptos is part of what happens to commodities. People improve in value and add value to lives. And the human nature is to create more with less every day. And that's part of why I point out where cryptos have value. But with commodities, it's the same thing. Every day that goes by, we can create more with less with technology. And so crude oil is going to probably drop below 50 on a normal trajectory. I might put, by the end of the year, I might put kill on that. But a lot of reasons why it's going to do it. And you see it happening everywhere. And then, so it's always the case. It just depends sometimes how you define the cost of production and where. So right now, the largest producer of crude oil and energy in the world is the U.S. So the U.S. cost of production around $56 a barrel, which is dicey, but it's the general estimate, shows that there's a lot of profits. And you just look at supply and demand estimates, and there's just an excess, massive excess of supply versus demand in the U.S. for liquid fuels. Why? Because we figured it out with technology. It just took a few years. I mean, I was pumping gas in the 70s. We had to drop the price on the pump from trading in gallons to half a gallon when the price went over $1. So that's where you rope in things like Bitcoin. I remember explaining Bitcoin and having a conversation with a very successful hedge fund friend of mine who really was involved with GBTC. I just got wind of these guys are all getting on that ARB about 2 years ago. Poof, that trade's gone, but it was a great trade. And I just pointed out, Harry, you point out the cost of production for Bitcoin is irrelevant. Why? Because you can't create more. Cost of production matters when you can create more. So 450 coins a day, 900 for the last 4 years. Cost of production doesn't matter, maybe for the miners and their profits and people who own their stocks. But when you can't bring on more supply because of price, it's irrelevant in terms of, so all that matters in cryptos, in Bitcoin, is demand and adoption.
Beautiful thing. And yeah, I heard you mention number go up technology. Yeah. So my only counterpoint to that would be that that commodity cycle is unavoidable. And I think something we'll touch on a little bit later today is how Bitcoin is extremely volatile through that cycle. And that's why it's important to try to think about incorporating gold into your strategy, because if you can minimize portions of that volatility, in other words, if we get a huge reversion in the stock market and Bitcoin goes down 60, 70, 80%, but gold goes down 10, 12, 15%. Meanwhile, the index is down 20, 25%. You are actually going to increase your purchasing power with gold. And, and then on the way back up, you're going to increase your purchasing power with Bitcoin. So I love how you tie in Bitcoin as a commodity into the system. And that kind of brings up this first tweet I want to address with you, because you sent out some monster tweets, even just today. So these are just fresh tweets coming up today. But the first one is gold. I believe there's two on gold. Which one do I want to start with? I want to start with
I think the first one I think you see there is, it's probably, I'm taking GLD divided by TLT. GLD is actually is the biggest commodity ETF on the planet, and TLT is the biggest bond ETF on the planet. TLT tracks U.S. Treasury bonds and GLD tracks gold. So what I show you in that white line is just, that's a total return. If of a real investor, if you're holding GLD, gold, and you do it versus bonds over time, you've had that kind of ratio. But right now, price of GLD versus TLT is really high. It's the highest in the lifetime of these ETFs back to 2006. And it's just looking for reversion. It's a spark waiting for reversion. So I'm bullish gold. But I think the next biggest trade is U.S. bond yields collapse. I've been wrong. I've been early. But I show you one reason why. What you see in orange, if you look at the U.S. Treasury 10-year note yield and you subtract out the 5 top countries in the world, the average of their 10-year note yields, these are government bonds. That's China, Japan, Germany, India, and the UK. The U.S. Treasury yields about 100 basis points more than those top 5. That's just pretty extreme. It shows you how the system potentially is breaking for the rest of the world. I mean, why is Japan having to support their currency? Why is China having to support their currency? It's because their yields are so high in the U.S., rates are so high, and the rest of the world, in terms of bond yields, are tilting towards recession. So it's one of those lessons I learned in the trading pitches of bond traders. One of the best indicators in the world are bond yields, government bond yields. And that's my point, is if you look at bond yields in China, they're collapsing. China's in a pretty significant deflationary recession, the way I see it, just getting started. You're not going to see it in the data at all, because you can't really trust the data from a country that's led by one person. There's no open discourse. There's no one like me pushing back and creating. It's one thing. I mean, people complain about our disagreements, but that's what makes us strong. No one can beat us. Because if we can beat the shit out of each other, who's going to try to beat us up? It's just not going to happen. So to me, that's just what I see there. But that's one thing that to me is the next big trade I'm looking for. Is at some point, a shoe's going to drop. Fed, I don't know if they're going to ease, but bond yields are going to drop. We're going to have severe deflation. And the key thing that's a driver for all that is what you said about if in the stock market. It's going to be a when the stock market reverts. And the key thing, like I show you in that chart, if you take, I go back as far as I could on, this is taking gold divided by the Treasury, the Bloomberg 20-year plus Treasury bond index. See how high gold is versus bonds? It's not so much gold being high, or is it bonds being low, bond prices? I think it's more the latter. Now, as we speak today on June 7th, gold's down like 3%, but copper's down 4%. So, but what's overlaid in that chart, which I really enjoyed putting on there, is typically this ratio of gold versus bonds was like tick for tick. If you take gold divided by the S&P 500. Now, here's the problem now. The S&P 500, gold it's gold. The S&P 500 is so expensive now versus gold. The ratio of 0.44, it basically takes almost two S&P 500s, equivalent 1 ounce of gold. That's just a little mean reversion waiting to happen. So I'm not someone to think gold going up, but the stock market, what I show you here. So you look at the stock market, S&P 500 divided by GDP. The ratio now is almost the highest since 1930. And just to give you an example, when I was trading internet stocks in 1999, 2000, I remember just playing around with some of them. The ratio of the S&P 500 GDP peaked at 1.5. Now I just take GDP in trillions and add 2 zeros to make it, 28 trillion is basically 2,800 for the S&P 500. Right now it's about 2 to 1. And if you just look at market capitalization of U.S. stocks, they're 2 times GDP. So when you're 2 times GDP, that was the highest ever was in 1929. I think it got close to peak, about close to 3. But then, the most relevant example is 1930. That's all that matters. The stock market going up or down is all that matters for inflation. It's that big part of the whole ecosystem. What I enjoy pointing out here is that right now CPI at 3.4% is being buttressed, buoyed by the stock market going up. Why? Because it's all that matters. When the stock market goes up, everybody feels wealthy, you spend, everything's great. Stock market goes down, it's the opposite. But the key thing is it's exactly the same way as it was in 1999, 2000, before the big collapse. But the key fact then was inflation did not go down until the stock market went down. You can see that in the chart. Stock market goes down, inflation remained sticky until into 2001. And when the stock market continued to go down, inflation finally collapsed. That's the problem now. And inflation's on the way down, but it's being buttressed and held up by this stock market that won't go down. It's going up, and it's going to continue until something breaks. And that's the problem. It's keeping U.S. rates high. It's making the dollar too strong. The rest of the world's starting to ease because their economies are starting to trickle downward. And at some point, it's all going to matter. And then I always look over at the U.S. Treasury T-bills at 5.3%. It's the highest in like 20 years. And volatility in the Treasury, in the U.S. stock markets on a 52-week basis is the lowest since 2007. That's an accident just waiting to happen. Just little mean reversion in equities is all going to be matters. And that's part of the reason I'm very, very worried about Bitcoin at these levels, because Bitcoin is basically the fastest horse in the race. I completely agree. If the stock market goes up, it should go up more. But we're so overdue for a little mean reversion in the stock market. I need to see how Bitcoin's going to react. And I still think that, it's got basically trades about 3 times the volatility to beta, the S&P 500. So that to me is one of the biggest risks, is when beta goes down. But it's going to matter for everything. Bitcoin is just the high volatility asset.
So this divergence really is what's so interesting to me, because we see the stock market continue to go up. We see CPI go down, and we've seen it before, like you mentioned, as you described this chart perfectly, where it came down, but when stocks came down, it crashed down. And we saw what happened with rates in 2022. We came down, we crashed down, but rates are still high, and now stocks are going up, so we have a divergence. But at the same time, rates are high, the dollar's strong, stocks are going up against a strong dollar.
That's part of, and it's not so much against, it's part of. So key thing I learned from my colleague Gina Martin Adams, who's our chief equity strategist, if you look at the US dollar on a trade-weighted basis, that's the one the Fed calculates, overlay it with the US stock market versus the rest of the world, it's a tick-for-tick trade. The US stock market, but dollar is going up because the stock market's going up and outperforming the rest of the world. That's what's keeping rates high. So one key fact is you take the S&P 500, divide by the MSCI ex-US index, think we have 40 years on data on that. It's the most expensive ever. Like, okay, that's a problem. You take the S&P 500 versus the Bloomberg Commodity Index. Just recently, it was the highest level in 25 years. You take it versus gold. It's the highest since 2007. Versus GDP, the highest since 1930s. So that's the key thing, is you can see how expensive equities are. There's good reason for it. There always is a reason. But I just look at it. All it needs is a little flip for a mean reversion. But the key thing is U.S. stock market is part of what's driving the dollar. And that's why key thing is that's the lose-lose I look forward to in commodities. Not look forward to, I'm fearful of. Typically, for commodities to do well, you need China to be, the world economy doing well, China to be demand pull, and the dollar to be weakening. Right now, the dollar's strong because the stock market's doing great. China's heading towards a collapse, not collapse, a decline. Just look at their bond yields. The 10-year yield in China is 2.3%. In the U.S., it's 4.4%. That's the widest range in 20 years.
Wow.
Their yields are going down for a reason. So
now, one thing I call for really is, and I've been called for a while, and I think the whole world has been calling for it for a generation, which is a real normalization of rates. And we seem to be able to get close to get there, but it never really happens.
So
and
what do you mean by normalization of rates?
I mean, I want to see the long end go above the short end, with the short end being elevated. So I want to see, a bear steepener, basically. In other words, I would anticipate, you can see on my chart here, I've been charting this for quite some time, since the inversion took place. And, we had a 25% drop going into that first peak we had, a 304-day cycle before we got back to that peak. And very interestingly, this is the US 10-year. We see a very similar cycle. We got a 25% drop, and we're kind of on trend right now to be back at those peaks. But then you take into account what you said, looking at China, looking at the rest of the world, we're seeing their rates go down, our rates staying high. Is it just a matter of time before we have to play catch up with them?
Yeah, that's what's going to happen. So I'll make a prediction. We're heading towards a typical severe deflationary recession, reciprocal to the severe money pump, biggest money pump in history, and on the back of the longest period in history of negative and zero interest rates. Study all the lessons of history. Boom and Bust is one book. The Price of Time is another book. I can mention more and more of them that I've read recently and dug into recently. It's just going to happen. It's a matter of time. And we're in that stage right now. I think it's we're going to look back and say this is a bit of a silly stage. Number one, the curve is inverted in this country for a reason. It's always mattered. It's been 2 years. It's the longest period in history, but it is on the back of something that has never happened in our lives. 4 years ago, we all thought we were going to die, and we pumped more money in the system than any time in history. 40% increase in money supply in just 1 year. Okay. Everything pumped up on that. We didn't die, and here we are. We're coming out of it. At the same time, what did COVID do? It flipped the switch on China. We all realized, okay, this nearshoring is a lot better. 6,000 miles away is a problem. And then what happened in President Xi cozied up to declared the unlimited friendship. That's a complete, that's just like a bazooka for taking an economy to mean revert. It's just, and rapidly advancing emerging markets plunging. Now we're seeing severe deflationary forces out of China. Like I mentioned, their bond yields are collapsing. Every single G country is trying to restrict a lot of their exports. Why? Because they're exporting deflation, most notably renewables, solar. It's just happening rapidly. The key thing that's holding everything up is the U.S. stock market, and U.S. stock market's on fumes. Part of the reason it's up is the massive fiscal spending, which is unprecedented on a percentage of the GDP since outside of a war recession. We all get that. It's part of the reason people like me are bullish gold and Bitcoin in the long term. And then the after effect of the biggest liquidity pump in history. We just can't measure these things. But I'm looking at the big picture. Is that curve you mentioned, it will invert, but I think it's going to invert because U.S. short rates are going to drop and bond yields will probably go down too, but to go down less. They'll all catch up to the rest of the world, and we're all turning Japanese. Now, China, the number 2 country in the world, is clearly turning Japanese. Chinese GDP 10 years are about 1%. Japan's, I'm going to pull this up. JGBs, Japanese 10-year notes are about 1%. They were down 0.5%. They're picking up. Chinese 10-year notes, CGBs, are now 2.3%. They're declining. They're all converging towards Japan. And the U.S. is the shining star. So I like to use that example of, our rates are still, people say, oh, they're deficit and rates are going to go up and long bonds are going to go to 7%. Those type of things are completely global recessionary trajectories because the whole world's tilting downward and there's only one little inflection that's going to make it accelerate, and that's the U.S. stock market. Everything is dependent on U.S. stock market going up now.
Just how bad is it? Let's say the U.S. stock market has this meme reversion, because I think you've done a great job demonstrating in your charts that these valuations are, for lack of a better word, actually, I'll just use a nice word, they're historic, right? We're putting in historic levels.
I was going to interrupt you to say that. I'm glad you said it. Historic, that's all. That's the best way. And mean reversion always happens, just a question away.
So my concern is, and my argument would be, and I think most people in Bitcoin would emulate this, is that you're right. You're absolutely right on the overvaluation and the historic numbers that we're seeing right now, and not only in prices, but in earnings ratios, the whole 9 yards. So if we get to a point where we get extreme deflation or just a deflationary recession, it doesn't even have to be a depression, just a deflationary recession, I would say that based on, the laws of economics, that's actually a good thing, right? That lets prices come back down, that increases demand, it punishes mismanagement. Like we're due for a deflationary recession. Matter of fact, we're probably due for a deflationary depression. The problem is the reaction to it.
Well, it's a great thing, except in an election year.
Yeah, but we're not going to get it.
You're spot on. And it's a short-term pain for long-term gain. So here's the thing I'm looking for. Everybody says you vote your pocketbook. I'm waiting for a good leader to say, okay, do you want to vote your pocketbooks or your kids' future? Do you want your children, your grandchildren to look back at you as the selfish ones who screwed up the whole system by being too greedy? And we're getting to that point now. We're just spending way too much. We have to tighten our belts as a country. There's so many ways to do that. And I'm not going to suggest how to do that, but we have to. The runaway deficit has to stop. And a good way to make that happen typically is, unfortunately, oftentimes it takes a recession for people to get serious about what's happening. And the problem, I think, is, yes, it's an election year, but this is where I think it's the best case I can see right now for what potentially is going to happen is what happened in the 30s, in 1929, because everything was predicated on once that bubble burst, and I point out now is on the way up, there's been the last time in history where stock market was this expensive versus GDP was 1929. It's at some point it'll revert, and that's all that matters. So I hate to say it, but it's just the fact of where I think things are going. So here's another thing I want to add to that. So I looked at one thing that really helped. One of my best trading years ever when I traded was 2008. I just had to take the pain in 2007. And the key indicator I was watching was the VIX volatility index minus the T-bill rate, because T-bills are competition for the stock market and VIX show you the risk. That 52-week moving average reached the lowest ever. Right now, it's around 9%. VIX volatility index 52-week moving average minus T-bill rate is the lowest since 2007. Okay, so here's the number one lesson I learned in trading options in the Chicago Board of Trade trading pits is volatility is always mean reverting. So it's just a matter of time for that volatility to go up and the T-bill rate to go down. And it's not going to happen until the stock market goes down. So these things can last for a long time. But I just point out it'd be wonderful if we can get through this without some normal mean reversion, which means pain for some people. For traders, it just means opportunities. And one of the best leading indicators for this, CJ, might be Bitcoin. Because I want to harken back what you just said for earlier. I think it's 24/7 traded, 365. It's the number one leading indicator on the planet, bar none, on a 24/7 basis. And it was a great fastest horse on the way up. And that's what I've been showing lately is I'm really concerned if you look at Bitcoin versus gold, Bitcoin versus S&P, Beta, Bitcoin versus NASDAQ. Sure, we put in those pretty significant peaks in 2021 for good reasons, the biggest money pump in history, but they're all showing divergent weakness. And people say, oh, you're picking a point in time. I'm just like, no, I'm since the beginning of Bitcoin, certainly since 2007. To me, that was a significant when futures came on place and they entered the adult world of hedging. That I'm really concerned about this divergent weakness we're seeing from Bitcoin. And I'm seeing in everything. I'm seeing gold outperform crude oil, gold outperform copper, gold outperform silver. And the things that are not supposed to happen in a rapidly expanding economy are all telling you that this is all brewing. And so that's why I watch it as leading indicator. That's why I still say if people are long Bitcoin, overweight long Bitcoin, they should keep a very close eye on beta because beta is way overdue for a correction. And at some point, we're going to get beta to go down and Bitcoin to be that digital gold and go up. The problem is, have not seen any sign of that yet. I want to, as a strategist, I always think I'm kind of trying to be ahead of it. My rule sometimes, what I get wrong sometimes is I'm too early. And this one is, I'm just pointing out, when you have an asset, so I like to point out, just as of yesterday, until gold collapsed to like 3% today, as of June 6th, at the close on June 6th, if it was the end of the month, Bitcoin, Beta, S&P 500, and gold all were at record highs. And I point out is when you did get a correction, the difference is the lowest volatility of those is Bitcoin. And both Beta, S&P 500, and Bitcoin are, I'd say Bitcoin trades 3 times the volatility of both Beta and gold. So that means if Beta goes down, gold should come out ahead.
Yeah, absolutely. Well, one thing, because I do want to start to transition into our next topic, but before we do, I just have to touch on this because I heard you say it 2 ways. First was that the deficit spending needs to be reined in, and second was that the stock market, the prices play a big role in inflation. And I like to kind of break it into 2 separate segments. I like to think of it as supply-demand equilibrium and then overall monetary supply. So from the fiscal side, we're seeing that spending is playing a big role. They're borrowing money, the principal stays on balance, and they're spending it into the economy. That increases the demand. So we get inflationary pressures. But on the other side of it, you for the first time now since the hiking schedule started, we're seeing global liquidity increase on a net basis. So it's interesting to see, and I just want to get your opinion on inflation. For you, what is the exact definition of inflation? Is it just a monetary phenomenon, as Milton Friedman would say, or does supply demand play a role in that? Or are we talking about 2 separate price pressures here?
In the big picture macro, it's always monetary. Always. Big picture macro. Certainly when you use other currencies, live in other countries. It's, why is one thing you get in Miami and Florida, right? Certainly Miami is virtually everybody who comes here from a South American country understands melting currencies. There's a bit of a bias towards crypto for that reason, and certainly Bitcoin for store value. And so absolutely, yes. But then there's also if you dig into the weeds, there's nuances. So here's the thing I like to point out in terms of severe deflation. The price of natural gas this year dropped to the level it was first traded in 1990. This is the benchmark measure for heat, electricity, and fertilizer in the country. Measure that traded 34 years ago. That's severe deflation from a producer's standpoint. How does it happen? Well, we create more with less of it. We create more with less every day. We use more of it. But even this fact that over that same time, the price of the amount of money supply and inflation went up a lot, natural gas has declined. So that's just one example I want to give you. But overall, inflation is monetary phenomenon. Always more dollars, more pieces of fiat currency chasing physical goods or services is the bottom line. And we did an experiment in the last 4 years that will go down in history as, I think, a normal reversion. Now, this is the lessons of Jeff Booth. Jeff Booth is a big Bitcoiner. You know who he is, wrote The Price of Tomorrow. Yep. Yeah, I mean, Jeff's great. I consider him a friend. And that is, humans are always about error correction. So here's an error we learned in the last 4 years. We learned the error of too much liquidity inflation. And the problem with inflation is it really hurts the average person the most, and it really accentuates that wealth effect. Where people who own property and homes are doing great, and anybody who's renting and just earning a wage gets hammered. So that's got to be fixed. Certainly, from a political standpoint, you got to control inflation. If you want votes from the masses, you got to control inflation. It hurts everybody. So that's going to happen. So here's I'll predict the future again. So the interest rates in this country went up on the elevator. I think they're going to go down in the escalator. That's the opposite of what usually happens. And because every single time now there's going to be pressure to cut rates, it's not going to happen because there'll be so much pushback to say, okay, well, last time you cut rates too much, you created all this inflation. Are you going to do that again? And here's the difference is, again, that's why I point back to everything is going to drop down to the stock market. So I don't think it's silly now that we're still priced for easing in the US system. And we have massive speculative frenzies going on in stock markets and inflation well above targets. The Fed does not ease in that environment. They hike in that environment, but they keep saying they're going to ease. That's helping pump up stocks. It's helping increase that wealth effect, and it's keeping inflation buoyed. So I think the number one thing to make the Fed ease is the stock market going down.
So it's there's that strong psychological angle to inflation and people's spending habits.
Oh, completely. Oh, yeah. So, and a lot of it, when you look on the tape, exactly psychological. I remember really well in 2008. When you look on the tape, when the stock market goes down, it's everywhere. I mean, when you see crash, it's everywhere. You can't avoid it. Newspaper everywhere. When it goes up, yeah, it's kind of great, but it's psychological very much. And here, I'll give you one example. I remember it was 2008. Things were collapsing. I went to a mattress store to buy a mattress for my kids. My kids are all adults now. I remember it was empty. This was in Fairfield, Connecticut, Fairfield County, Connecticut. It was quite the busy place. And I always ask how things are going. I talked to the owner of the store and I said, how's business? He goes, have you looked at the stock market lately? I was surprised by that answer. He said, we haven't had customers here, any business here for a couple of weeks. Because people see things collapsing, they stop spending. It's just normal. That's initial. That even started now. I mean, it's just the wealth effect too. That's initial psychological. And then it's the actual money and losing jobs and the wealth effect. That isn't even started. It's going to happen. It's just a question of when. I just think it's my duty to warn people.
So in your opinion, because I agree with you and I think that's imminent. And when it does happen, do you think the government is going to print more money than COVID or less money than COVID to fix it?
So I think I will make a risk by saying this. The amount of money we injected in the system during COVID will never happen again, unless we have some kind of third world country. We made that mistake. Jeff Booth proved it. And we'll say it's the lessons of Jeff. We made that mistake of too much liquidity and rapid inflation. So what's going to happen, I think, is we're going to have pressure because inflation is going to remain sticky. At some point, printing money is, we all learned, we got to be careful of inflation. At some point, we might get a leader that's going to say, hey, we're going to kind of tighten our belts here a little bit and think of the next generation, which probably means there won't be a reelected, but we'll see if that works out. That's why it usually takes a second-term president, which we're getting at very soon. And it's going to be that time. But I don't know exactly. I just know that as far as cycles and measures and size, always you have these cycles, and it's a question of how it works out. But the difference with this one is we created it by creating way too much liquidity, inflation, and the biggest money pump in history. And the proper way to react is not by doing what we did wrong before.
Yeah. Well, so, I wish we could learn from that lesson, but we might not. But let's say we did learn from that lesson. I want to get your response to this because this has been something that kind of has surprised me and taken me aback in my research and analysis. And that is, if we get the much needed deflationary recession, what could happen actually is that deficits would actually expand because tax receipts are going to decline. And now, if we get that prices could come down, but now we're printing money. Now we're printing money at an even faster rate because of our mandatory spending obligations. We're talking about $216 trillion of unfunded liabilities now, and that could grow significantly through a depression or through a recession. And then what if the prices don't come down because the amount of liquidity that needs to be provided to pay Social Security and Medicare, to all of that mandatory spending in the budget that really just can't disappear without affecting people's lives dramatically to the extent where you could have a political crisis on your hands. So to maintain the status quo and make it through a recession or, God forbid, a depression, it might actually require more printing than we are doing right now. What's your response to that?
Well, that's typically, it's called in the Keynesian prime the pump. You get recession, you're supposed to do that. You prime the pump. The point is, I think we already did that, and we found out the errors of doing that at the wrong time, too much, and getting inflation. So let's use the example of Japan. Debt to GDP is almost 3 times.
Hold on, before you go too deep on that, I don't think anybody in a decision-making position learned that lesson. I think astute strategists like yourself understand it very clearly. But the people who are in decision power, they're not. Jerome Powell and these Fed presidents are not coming out talking about how that was a mistake. Everybody is hailing them as the heroes who got us through COVID. And hey, we're back to normal now. Great job, guys. You took a world pandemic and there was no bad thing that came from it. That's the narrative I'm getting from them. They made every right move. Maybe they did things a little bit too early or a little bit too late, but it was just a very small mistake. This wasn't oh my God, we injected the most liquidity ever, and we're never going to do this again because this is an important learning moment. I'm seeing the opposite. I'm seeing hubris, and with each QE getting bigger and bigger, I hope and pray that you're right for the sake of our children and the health of our economy and sustainability of U.S. dollar dominance. But I don't think they're learning that lesson.
So that is more macro and psychological. I just look at it as a strategist. Number one thing I think is more likely to happen is everything goes down. That's bond yields. I just think of my job is to try to help predict markets. Equity, risk assets, gold goes up, bond prices go up. All that other stuff, we'll see. That'll be the next bridge. To me, this is getting through the first bridge. The first bridge, let's start with one bridge at a time. A 10% correction in S&P 500. We've only had 5% since the bottom in last October. So I teased around before I wrote, okay, we haven't even had the first test this year. We've had a quiz. We went down 5%. What was one of the worst markets was performed. Bitcoin did its usual, dropped, but crude oil collapsed. Then it went back up. Because to me, I just point out is, let's get through a 10% correction. Let's get through that first iteration. Let's get through 20% and see what happens, see how markets react. That's my point is, for people who are long and bullish Bitcoin, I say, let's get through that first 10% correction and see how it reacts versus beta. I like to point out the fact that the last time we had a decent correction in beta, it was 25%. That was for COVID. Bitcoin dropped 80%. That's what you'd expect. Why is that different? And that's what I point out. When I look at the market as a giant value at risk model. And when I was at a hedge fund, actually, we used S&P 500 as the benchmark for all risk assets. And to me, that's even more so than ever. That was 20 years ago. So that value at risk model has stocks, bonds, cryptos, Bitcoin in there. And to me, the main risk everybody has is just a little bit of reversion lower in beta and how everything is going to react. And that's why I've been pointed out it's probably better off being overweight things like gold, some Bitcoin in that space, and it's definitely treasuries. I mean, you're getting 5.3% of U.S. Treasury note. Haven't been able to do that for almost 2 decades. And at some point, long bonds. And now I'm thinking that's going to be the next big trade. And that's what you pointed out. I was hitting the tape on today. It was pointing out how gold and TLT is getting so cheap versus gold versus stocks versus everything. And bond yields are so cheap in terms of bond prices are so cheap versus the rest of the world. And it's only waiting for one little inflection.
Right. Now, one thing you said earlier about Bitcoin when we were talking cost of production was the really only thing that matters is demand and adoption. So I would answer the question when you say, so what's different this time? I would say, well, what's different this time is that previously Bitcoin has just been magic internet money. Now with the launch of the ETFs, a very successful launch that is demonstrating the growing demand on Bitcoin, almost growing the network is growing at a rate that actually exceeds internet growth. So what's different this time, in my opinion, is that we're seeing Bitcoin as the reserve asset of the internet economy. Now, of course, the dollar representing the US economy, Russia, China, Japan, their currencies representing their economies, really being a derivative of GDP, right? And the ability to close that liability with increased GDP. But Bitcoin, as the reserve asset of the internet economy, it's an aggregate economy. The internet economy is it's Russia, it's China, it's India, it's the United States, it's South America, it's everything together. And we're seeing demand grow at a substantial rate. And we're seeing adoption grow with new tools, increases in technology, making it easier to onboard, easier to custody, or even having a BlackRock custody for you with the ETF. So I would be really interested. I'd actually love to see a 10% correction just to see if this demand that we're seeing in Bitcoin right now. I think ETF inflows on BlackRock the other day were over 300 million in one day. So with that kind of demand, do you think that Bitcoin is like in a position where we might start to make that transition? We're not going to be so highly correlated to beta. We can start to break away just because of that S-curve adoption, the supply demand dynamics of this new network growing at a exponential pace.
So I hate to say how long I've been writing that that's going to happen, and I want to see proof of it, and I have seen anywhere near signs of it yet. And that's what I've been pointing out lately. I'm seeing the opposite. Show me the proof. So I agree with you. Give me a 10% correction. Number one, let's start there. Normal bull market correction. Let's see how Bitcoin reacts. I'm sure you're also going to get hammered. Let's see how digital gold works. The problem I point out is when people talk about like high levels of cash, it's not true. If you look at cash versus the market cap of the stock market, it's very low because people are not taking a lot of profits. Now they're diversifying some into Bitcoin, but I agree with you. Let's see that. But my point is that's hopium at the moment. It's another vernacular word I love learning from crypto people, and that is prove it. Show it to me first. And this is where I get in debate with crypto people a lot. They tell me what should happen. I'm like, okay, I agree with you. It's going to happen, but there's been no signs of it whatsoever. Yes, we've had this bounce, but remember, we're in right now the hangover stage of a perfect storm for Bitcoin to make a new high. No, I wasn't on top of this as some other people were, but the approval of ETFs in the US, the halving and beta making record highs. Now we did that in March, in Q1, in March, April. We've already done that. So now we're in the hangover. And the people who didn't sell are keep saying it's going to go up. I mean, you're supposed to have sold some, probably. And then, because it became an overweight part of your portfolio. But that's when I point out all these ratios that I've been watching for a long time that have been leaving beta are lagging. Typically, number one is Bitcoin gold. Now, that's probably looking better today. But as we speak on June 7th, gold's down about 3%, and Bitcoin's dropping now almost about 3%. So to me,
I love that word hopium. That hopium is a good word. And speaking of hopium, I have some FedWatch tools here, which is this has been hopium for quite a few quarters now. We see these blue boxes continually shift to the right as time goes on. And right now we see markets pretty much anticipating, at least up until September, that rates will stay the same. So I heard you say that bonds, the price needs to adjust. Now, my adjustment would be kind of counter to everything that's being signaled with China going down, a couple of central banks coming out and starting to make their cuts. It just seems like a matter of time. But I want to talk about the psychological component of the long end of the yield curve, because we see what people expect, but sometimes what you expect doesn't happen. So what would be the consequences of this being wrong and actually these boxes shifting more to the right as rates maybe go up another 50 or 100 basis points?
First of all, I like that what you said. It's such a number one thing to remember in markets is what Benjamin Disraeli said, the former UK Prime Minister. What we anticipate generally doesn't occur. And that's so true. And that's also as a strategist, when I get into space and I sense extreme bullishness, then I write bearish comments. If extreme bearishness, then I write bullish comments. It's just what we're supposed to do. But that to me is what you said is rates going up in this country would be a bit of a shocker. It would require the stock market to continue going higher. It would require probably the rest of the world rates perhaps going up. the rest of the world to really come out of this thing. One of the key things I'd like to watch is China coming out of this, and watch Chinese government bonds. The whole world is tilting the other way. It's the body's emotion factor. So remember, it's the cycles. And the cycle is that we've had this biggest liquidity pump in history, and we got assets really high. They started going down, and they're back up the highest levels ever. It's just going to start tilting the other way. So that to me is not going to happen. No rates going up in this country. The thing that I think it's less that it's been a fact since 2023, the Fed funds futures a year forward started pricing 100 basis points. And that year, that was 2023 last year, they still hiked 100 basis points. So that's the hopium the market's missing. It hasn't figured out yet. The market hasn't figured out yet. The Fed's not going to ease, I think, until the stock market goes down. Because inflation's staying high, which we showed in that chart earlier, because the stock market's so expensive, it's keeping inflation, keeping everybody happy, which is great. But that's not an environment where, like I said, in that environment is where you're actually supposed to hike. But I just don't think that would be a shocker.
So I want to get your take on this, because this is something that I've worked on. We have the official government headlines for CPI based on the current methodology. It's a legal methodology, right? They pass the bills, they write the reports. Everybody knows what's going on. It's not behind closed doors or anything. And a lot of people always point at me and say, CJ, you're just, you're just crazy. They don't manipulate the data. And to that point, I would say, yes, you're absolutely correct. The data is. When I built this website, what I found out was it is an absolute amazing thing. It might be one of the very few things that the government actually does right is data aggregation. They share all this data that they collect through all of us here in the United States, hundreds of millions of people, economic data, jobs data, and they share it with us. That's a beautiful thing. My problem is not with the data. I think the raw data is a blessing to the marketplace, and it's a tool. But what happens is when you start to switch methodology. So I want to kind of just look from the opposite side of the lens and get your take on this. What if somebody was saying, yeah, the rest of the world is lower than the United States, but it's really just because of this real return right here, right? So if you go back to the 1980s and you use the cost of goods index, which is an index that was designed to maintain a constant standard, to measure a constant standard of living. There was no substitution. After that, they got into the cost of living index. They made that change, and that incorporated hedonics and substitution, where they try to account for people's behaviors changing when prices change in the marketplace. And what I find so interesting is that if you just go back to the government equation, right? Like everybody knows truflation. It's to me, it's such a waste of a good name because it's a proprietary algorithm based on their interpretation of how to measure inflation. But what we do here at Govflation is we just go back to that cost of goods index, and you can look at CPIs at over 11%. But what's more important here is the real rate of return, right? Because even with the highest interest rates that we've had in a very long time, and the best risk-free rate in the entire world, real rates of return are still negative. And other countries' real rates of return are even more negative because they're struggling more than us. There's more dilution going on. They're struggling. They need to print. They need to increase money supply. They need to extend credit to make it through. So do you think maybe that it's not necessarily the nominal rate that is driving macro, but perhaps these big money players are starting to realize, I didn't used to think about this risk over the 20-year period. I knew I was going to end up, I know I have my money. I'm not worried about the credit risk. I'm going to get my money. And, at some point in time in that 20 years, the cycle is going to click and I'll get increased purchasing power and I can buy the blood. But we're seeing a lack of blood. We're seeing increasing negative rates. And to be quite honest, just like the stock market measured against GDP is insane, debt against GDP is starting to get to insane levels. Are real rates playing more of a role than the market wants to admit? And in the United States, they say it's the cleanest shirt in the dirty laundry, right? Well, we have the lowest negative rates, but everywhere else, real rates are even more negative. So I feel like these nominal rates can kind of paint a dangerous picture where if you are paying attention to them and basing your investment thesis on that solely, you'd think you're getting a real rate of return, a real positive rate of return over 2%. Which is a great deal, especially in U.S. government treasuries. There's no better deal than that with a positive real rate. But you and I both know they can't give out positive real rates. The burden of the debt would be too much. So the real question becomes, how do we identify the real rate of return, and how bad is it? And it's over -5% on that carry in terms of purchasing power. So do you think that plays a big role in some of these macro managers? I know some people I've talked to.
I'll let you go on with, I mean, I think that's a great rant. I'll give you facts about, there's so many people in crypto who thinks the system's designed against you. Like, they go live in another country. Because my relatives came over here as peasants from Europe for a reason, and we've done okay. I mean, go try it. I've lived in other countries, not as much as a lot of other people, but so the point fact is about any type of PPI, CPI measure in this country is, yes, people might say they're manipulated, but let's look at the facts of my space. I'll just give you the facts. The price of crude oil on the screen right now, $75 a barrel, was first traded in 2006. It's almost 20 years ago. The price of corn, the high around 4, it's around 4 now, was first traded in 1974. That's just the way things work. The price of copper was first traded in like 2007. So from a commodity standpoint, I see severe deflationary forces despite all this money pumping. So when people say inflation numbers are not measured properly in this country, I studied, everybody has a different measure. They have to measure for the macro, and there's some very smart people. And the one thing that's different in this country is we question everything. So like you're showing gasoline.
I'm pulling up these charts because I want people to see what Mike is talking about. He's not kidding when he says deflation.
Show gasoline. So with the price of gasoline first tried in there $4 a gallon in 2008. That was one of my key bearish signals. Like I said, that was a signal. I was just waiting for mean reversion. Long bonds, long gold, and short stocks. Didn't have Bitcoin then. I can't really trade anymore, but it's still the same price. That's unleaded gasoline, so it's $3.50 or so. Just that's deflation. Okay, it spikes and it stays that way. So it's just remember, in the macro big picture is, unless there's a greater amount of money chasing goods and services, those prices will go down. It's just the way it usually works. And that's why I point in commodities. Look at gold. So the best measure for everything in terms of risk asset value is gold. Gold versus S&P 500. Gold versus an acre of farmland in the Midwest. Gold versus a men's suit. Stable over time.
Yeah. And when you look at this chart and you see, guys, that what Mike talking about here about these things are actually being deflationary. They're making deflationary moves. They're signaling deflation. But we talk about the commodity cycle. You see, we go below the zero line, we come back up. We go to that discount era. We come back to fair value. We go to premiums.
There's your cost of production and the high price, low price curves. It all works in cycles. The problem is right now the cycle still remains downward, and the number one commodity that already probably bottomed is natural gas, and I don't think crude oil and corn have yet. So because natural gas got cheap.
When I look at this chart, what I look at is I see, unless we get some extended period of time, and it's not really that extended. Look, here's 2008. Here we saw what happened in 2015. But right now, we've kind of almost finished the discount portion of the commodity cycle. To me, it looks like.
Oh yeah. So for natural gas, yes. You're looking at a 12-month basis. I'm looking at more cost of production. The cost of production for natural gas in the country is $2, and we got below 2. Okay, it has bounced. Right now it's like 2.70, almost 3. That makes sense. The cost of production for crude oil in this country is 56, maybe 55, maybe every single bottom since 2014 has been 40. Is that different? Okay, there's more money chasing the same amount of crude oil, but it always is. Corn.
I love how you use the cost of production, because that is my main indicator for all of my investments. Well, it's also how you measure it. So that's subjective. But the key thing I always point out in all commodities, the thing that's not subjective, that's the same real time for everybody, is prices. So one thing I enjoyed, I was at the SME Metals and Mining Conference a couple weeks ago in New York, and I presented there with a guy from the World Bank. He was pointing out how he's measuring some of these oil supply and demand trends. I'm like, how do you measure the black market? You can't. I mean, you have Russia and you have sanctions and China, and there's so much going on that's under the table now that he says, one way you can is prices, and prices can help guide you where things are. And so it kind of tells you if your assumptions are right or wrong. And one thing everybody missed in crude oil when they said it was going to 150 is that it always goes, it's the most autocorrelated asset in the world. It goes down because it went up. And that's the opposite. I mean, it's just one of my favorite technical things. I've been getting kind of toward the end here. It's one of my favorite technical indicators that works in stocks. People say it all the time. Well, it's going to go up because it went up. You can say that in Bitcoin.
But now Bitcoin's becoming more of a commodity. It went up mainly because it got hammered down to 15 with SBF and that whole big thing. That was a classic buy signal. But now the problem is it's gone up. It might just be more of a commodity and go down because it went up. Sorry, but that's the way commodities work.
Yeah. So getting into our last couple of things here, and knowing the value that commodities play in being able to ascertain where we are in the cycle and how to kind of try to look in our magic ball, knowing that we're never going to nail it, but sometimes we're early, sometimes we could be a little bit late, but it gives us value. So what role do you see Bitcoin playing as a commodity in the long term in the TradFi system?
Oh, digital gold, store of value, alternative asset. It's going to be part of everybody's portfolios. I agree with what Saifedean Ahmed said in his book, The Bitcoin Standard. I think I read it in 2018. I additionally disagree that it's going to be part of central banks. And I thought, nah, never. But now I see every single day that goes by, I say clearly, if you're holding gold, if you're biased towards gold, don't take the risk of not having some Bitcoin, is what I say. So to me, it's just unstoppable. But we have to remember that it's still a highly speculative, highly volatile risk asset. And when beta does go down, it's just a question of when, depends on if it's a long time from now and Bitcoin has that time to really mature more, it'll be fine. But still, that's the problem is unless it has a negative delta, which is a put position does, to beta, Bitcoin has a problem with beta going down. And it's just showing divergent weakness lately. And it had a perfect storm for a new high. And here's the key thing that we were at that conference, the Bitcoin Day. And one of the people, I'll end with this, in Miami-Dade College. And one of the people on our panel, one of the guys in the audience was pushing back on me. I thought it was funny. And the guy in the panel said, oh, Mike's a Bitcoiner. I'm like, it hit me on the panel. Like, that's the problem with the space. Would you not have me on the panel if I wasn't bullish Bitcoin? That's where you got to be concerned. Because I've been bullish in the big picture, and just shorter term, I'm just pointing out the risk assets all have a problem. When I look at beta, it's expensive. Bitcoin's the riskiest of them, and it's still not showing that negative delta to beta.
Yeah. So I agree and I disagree, but this is my show to get your opinion, to deliver your value to my viewers. And I think you have a very sophisticated view of commodities that is going to benefit people to understand that, there's going to be volatility. And I think with Bitcoin, the best thing about Bitcoin is if we can mentally prepare for that, even though we suffer nominal losses in the short term, in the long term, we know that number go up technology is working for us. And Mike, I know we're going on time, but I want to pick your brain, if you don't mind, just one last topic.
Shoot.
And that is what you were mentioning earlier about stablecoins. I just want my listeners to understand for the importance of US dollar dominance. And I want people to understand the importance that Bitcoin and crypto play in making sure the dollar, like you said, those people over there are like, hey, now we have access outside of our system to the dollar. And now we're starting to see Larry Fink tokenize debt, right? We saw the tokenization of the dollar. Now we're getting the tokenization of the treasuries. Everything's trending towards tokenization, as you said. Just for our audience, can you give us a little view on where you see this going, how fast you see it moving, and then what it means for the dollar and for the future of American citizens who depend on US dollar dominance around the world?
Let's start with the macro. This rapidly advancing technology that's completely organic on a global basis adopted the dollar of its base layer. That's a statement, a fact that you don't mess with if you're an American. And our breathers and regulators, I write about it because I expect they see it because I read it in the Bloomberg terminal. You just don't mess with that. And so as we were speaking, you might see I always click on CoinMarketCap and I click on volume and I see the latest for Tether for 24 hours is $80 billion of trading. And for Bitcoin, it's a third of that. On a daily basis, the number one traded crypto on the planet is the buck. It's not Bitcoin. And so everybody's trading these pairs is going through Tether. It's imperfect. I get it. All new technologies are, but it's like the talking chipmunks and Alvin and Chipmunks. They talk. It's all that matters. And that's my point is on a global basis, when you see, I remember it was like a couple of years ago, when you see Visa saying, hey, we can, with crypto dollars, I don't like to call them stablecoins, I like to call them crypto dollars. We can, square up our positions instantly for like nothing. We're going to do that. MasterCard, same thing. I mean, That's one thing that's why I come from futures. It was just a better way to mitigate risk and transact. The tokenization of all assets is unstoppable. Yes, there'll be pushbacks. It's just a better way. Ethereum is the number one way to make that happen. Now, this is where I point out I don't dig into that anymore. There's Solana, there's all these other protocols. I have the book in front of me, Blockchain Explained by my friend Kyle Sullivan. I have to read that one. But it's just, you don't, and certainly from an American standpoint, how do we win, how we beat the world on most things is we adopt technology. And so that's why I say, especially Tether, $12 billion. That's what, 15th largest holder of treasuries on the planet, the most profitable company per employee.
Yeah.
And I've only heard people push back on it, and I just point out facts. So, well, just the better way.
The demand is there. Now, one little nuance here, and this goes back to our time at the Energy Summit with Byron, because he had mentioned how the demand for the dollar, for the treasuries, is increasing because of the stable coins. And I believe Congressman Bill Hagerty of Tennessee, he put the original stablecoin legislation bill forward. And in that bill, each stablecoin has to be a reserve-backed stablecoin by the dollar through cash equivalents, and cash equivalent being defined as liquid U.S. Treasury, so short-term Treasury bills. So my question to you is, have you heard in the circles, or what do you think about the concept of these financial services committee pushing through stablecoin legislation, not by itself, obviously, but attached to another bigger, broader bill, and then the second and third order of effects? So what I said to Byron was, hey, it's fantastic that stablecoins are a source of demand on treasuries, but now consider what you're doing for the marketplace. Because if you legalize these stablecoins, then now people have two choices. You can have a bank account that's backed by 1 cent or 2 cents, or let's just give them the benefit of the doubt and say it's backed by 10 cents, even though it's not. So you can keep your money in the bank, not have 24/7 access to it, and be dependent on somebody else custodying your money, and have it be backed by a dime to every dollar. Or you can keep your dollars in stable coins, which are backed by law 1-to-1, eliminating that fractional reserve risk. Do you see any maybe second or third order effect risk to the banking system, who's already a little bit on shaky ground here from the Silicon Valley Bank fallout?
Adopt or fall behind.
Yeah, so the bank.
I don't know how they're going to do it. I just look at the macro as they have to adopt or fall behind. But I mean, the one thing that's the most important things in successful countries in the world is property rights and fractional reserve banking. That's Jeff Booth taught us that. So let's not go back to the negative days of It's a Wonderful Life and Mr. Potter. So how we're going to do that, I don't know. That's for the people smarter than me to figure it out. I look at from the macro, like from the beginning when I was talking to my our FX strategist, Audrey Child-Friedman, about this. So I don't really follow crypto. I'm like, Audrey, this was years ago. I said, but the point is, if you're anytime bearish the dollar, here's something that shows you why you should be bullish the dollar. The world's gone for the dollar through cryptos. Tether, all the other ones, I call them crypto dollars. So to me, the macro, from my standpoint of where my assets are going, is this is just shows how the U.S. is crushing the rest of the world, most notably China. Why didn't they go for the yuan or the yen or the euro? Went for the baht. So all the other stuff, I'll let you guys work that out. I mean, I don't follow much anymore, but it's kind of stuff I'll see how it works out. But we're not going to mess this up. The U.S. will. It's not going to mess up cryptos. It's not going to mess up Bitcoin. It's just like we're talking about the most widely traded crypto is Tether, $112 billion tracking in treasuries, and it's only been going up for what, 10 years almost?
Yeah, it's a net positive for this country and the future of U.S. dominance.
Well, so that's the thing. The U.S. goal wasn't to be dominant; it was to be successful. I mean, what's the goal of all of our history? Is we just want to trade with you, like with China. Yeah, we'll trade with you, and then they decided to want to support this war. I'm like, oh, that's a problem. Okay, so that's bad for China. It's always been the Marshall Plan. Is we just want to trade with you. The whole essence of I just enjoyed reading that book. I think it was called "The City at the Center of the Universe" or the world, about the founding of New York. It was just everybody there just wanted to have a chance. That's the essence of the foundation of the country. Some people obviously ought to dominate. We're not. Now we have different things, but just want to do business. I mean, Canada does pretty well with us doing that. Mexico does pretty well with us doing that.
Yeah, absolutely. It's the ethos of freedom, really, and I think that's
We just want
Bitcoin's big advantage is
yeah, well,
through
exactly.
free
And
market.
and one thing I love about it too is it's so unifying. Everybody in the planet can be unified via Bitcoin. It's so cool. You can meet people at conferences from all over the world, and they're trading Bitcoins, oftentimes with dollars.
Oh man, ladies and gentlemen, Mike McGlone, senior commodity strategist, Bloomberg Intelligence. Mike, it was an absolute pleasure. Thank you so much for sharing your 2 cents on these important topics. And we'll be keeping a close eye. If you don't follow Mike, follow him. He puts out great charts, great analysis. If you're a big time trader, subscribe to Bloomberg Terminal. Make sure you're getting the reports and the articles. Mike, thank you so much for joining me. And I hope you can join me again sometime.
Thank you, CG. I'm looking forward to the next time.
Take care.